Welcome to the Daily Update, where I'll go over the action in the market for Friday, July 21st, and then we'll see how things look for Monday, July 24th. I apologize if you hear some noise in the background. There's some work going on around where I'm at. I can't really control that, and anytime I wait for them to stop, then it seems to pick up again, so I'm just going to have to power through this. We had pretty much an unchanged day based on a closing basis. We're seeing some improvement in some charts. They're hanging in there pretty well. We're seeing a little bit of negativity in some other charts. It looks like for right now, the last 2 days, we're seeing more of a short-term pullback before the market gets set to go higher. Now that can change at any time. We can turn drastically more negative, but based on what we see right now, the market is holding up. So let's go back and talk about what happened. We had a higher open with prices chopping between the daily pivot at 45.42 and R1 at 45.57. Never got quite up to R1. As the day went on, we just chopped above and below the daily pivot, and then we ended up closing down below the daily pivot. We were up 0.03%, so pretty much unchanged on the day, but volume was above average because it was options expiration. The technicals were still hanging in there positive. We are working off some of this overbought situation that we're in the short term and intermediate term. So far, things aren't switching much more negative because the market continues to be fixated on inflation and interest rates. What are some comments that we can make? We're still watching this convergence of these negative signals that are continuing to show a short-term pullback. The broad market did hold up better than mega-cap stocks. That was the same as Thursday. Value outperformed growth. That's a little bit negative. We want to see growth outperforming value. The positive scenario that the market has is continuing, that we will have a soft landing without going into a recession, that the Fed is almost done raising interest rates, and looking out, earnings growth still seems positive. On a short-term basis, our list is getting a little bit shorter now. We have the moving average study, the CCI 20, the standard deviations chart, and the stochastics. Intermediate term, we have the rate of change 50 periods, the PMO studies, the oscillators. We're still watching those negative divergences, but so far it doesn't seem to be all that relevant. The Sean trend meter and the BPI both for the S&P 500 and for the NASDAQ 100. On a longer term extreme positive basis, we're still looking at the moving average study. The dollar was up and interest rates were down. And all of the yield curves still remain inverted. Sentiment is still extreme. We're at 82. That's showing that there's not a lot of fear. And our trend is positive. The green line is still coming down just a little bit, but the ADX is above its moving average and it's moving higher, but we're also close to that 40 level. Our bias is positive and our momentum is positive. We didn't have any economic reports that came out on Friday. Some IsabelNet.com blog charts. This is put out by Real Investment Advice. I'm not going to go through all of this. It's mostly historical, different things that have happened, looking at sentiment and the VIX, where they take those together. And then the blue area is the Fed funds rate. Then looking at weekly equity flows, we saw a little bit of an outtick of money coming out as the market was topping out there. But when we look at the 12-week moving average, we're still going up, but we have flattened out. June CPI print, likely the last for favorable year-over-year effect. When the next CPI reading comes out, depending on what we get, they translate that over into an annual rate, and these rates are starting to go up slightly. Bank of America asked some folks, when do you expect the global economy to fall into recession? We're still thinking it'll be in the fourth quarter of 2023, but that is lessening from where it had been. Some folks are still thinking we'll go in the first quarter of 2024, but that's also backing off. But what is growing is this idea that we won't have a recession in the next 18 months. Looking at the VIX seasonality, right now the red line shows that we're pretty low. But from July up through about the end of October, historically the VIX tends to rise from here, which usually the VIX goes up when the market goes down. So just something to be aware of. Also, the LEI, that came out on Thursday. That's a pretty important report right now. And it's also suggesting that we will go into a recession looking out 12 months. Here's the NBA U.S. Purchase Index. Now we're ticking up a little bit with home sales. And then we had the latest reading from the active asset managers. They're getting extreme positive. This is a very high reading right now. Now this data is a little bit old, so it's kind of lagging behind where we're at right now. Also, the debt allocation is set at 21%. Those are people that are in bonds. And getting into our charts and analysis, where we did have a higher open, we opened above the daily pivot, but then we came back down and we chopped along the daily pivot for most of the day. We never got up to R1, and then right at the end of the day, we came back down and we're barely unchanged on the day. Intraday chart, we were pretty much flat in the initial overnight session for Friday. We saw some strength coming into the market in the pre-market session, and then we chopped all around during the cash session, and we're pretty much unchanged as the market closes for the weekend. Looking at large cap growth versus value, this is a little bit of a concern. We're seeing the blue line underperforming the red line. We want the blue line to be on top when the market is more positive. Looking on a closing basis, growth was up more than value for the large caps. It also was down less for the mid caps as well as the small caps. So when we look at it this way, growth did outperform value, but intraday, value outperformed growth. Here's the intraday chart of SPY growth versus value, where we were slightly positive but very choppy in Friday's session. Sentiment still suggesting that fear is not very prevalent in the markets. The VIX did tick down a little bit with the line chart and the bar chart. It's still very low, suggesting that there's a lot of complacency. The VIX of the VIX ticked down just slightly, but we're coming down pretty much to the moving averages now. Looking at the VIX to S&P 500 correlation, we are continuing to drop after we spiked up here. When we take it together with other signals that we're seeing, that's probably negative for the market. And then we're updating our equity put call ratio, the 5-period simple moving average. This is a chart that takes a shorter time frame. We're wondering, have we bottomed out and are starting to go back up? The longer term equity put call ratio, it's still giving us a low reading, but it did tick up slightly on Friday. The longer term equity put call ratio is still looking positive. And we ticked down just a little bit with this fear chart, and we're declining overall. Our other fear chart is also showing that we're declining with fear. So there's just not a lot of worry out there right now. The ratio between risk on and risk off did decline, but it is advancing overall. Our advanced decline line studies. We did show some improvement here with the advanced decline line based on price. We were pretty much flat, but we're holding up based on volume. The new highs tend to look healthy as well, so we're turning back up now with our 5-period moving average, and we're already moving higher with our 10-period moving average. The advanced decline ratio was pretty much flat, but it is still above 0. That's positive and is holding up. This is a little bit of a concern. We saw the accumulation distribution really drop off, and it's now gone below the moving average. The cumulative NYSE advanced decline line showed a little bit of improvement, although we ticked down with the regular advanced decline line. And we're still holding up with our other NYSE advanced decline line above this upward sloping trend line. When we look at common stock based on price, we tick down slightly. Also with volume, we're seeing a little bit more strength with the price and a little bit of a negative divergence with volume. Our advanced decline line studies came down a little bit with the NYSE. We advanced with the S&P and turned down with the mid caps and the small caps. Our trend, we show the green line continuing to come down. The ADX is still above its moving average, even though it's rolling over slightly, and we're near 40. But we still suggest that we're in a trending environment and that trend is positive. Our shorter term ADX also showing the green line coming down, the ADX rolling over, and we're still in this 40 area, which can give us an extreme reading. Volume is continuing to pick up and turning back more above average. Our short-term charts, on the daily chart, it looks like we came up to the underside of this upward sloping trend line and have been bouncing back down from that. And then on the bottom, you see where we've had a number of days now above average with volume. We're still hanging in there with our 20-period double and triple exponential moving average. We're still riding both of those lines. But our 20-period exponential moving average is still extreme positive, as is the 50, and we're showing some improvement with the 200. The CCI 20 is coming down, but it's still barely extreme positive. The stochastics were not as extreme as we were in the short term, turning down but still extreme in the intermediate term, turning back down also in the longer term and still extreme. The force index ticked up just a little bit, that's positive. Looking at some intermediate term charts, the balance of power is no longer extreme positive. We are above the dashed lines, so it's still hanging in there as positive. Looking at the 50-period double and triple exponential moving averages, we're still above the triple exponential moving average, which is providing support. If we start to fall, we'll see, will the double exponential moving average provide support? We're still positive with the go, no-go system with the darker blue bars. Looking at the highest high versus lowest low values, we're coming off the highest high value, but we have not come back down to the midpoint yet. The TTM squeeze with the lighter shade of blue continues to be positive. We're right in between the second and third standard deviation, so we are working off that extreme positive reading. The rate of change turned back up slightly, and we're just barely extreme positive going back 50 periods. The PPO studies still remain positive in all time frames. We're ticking down just a little bit with our Arun indicator after being extreme positive. The buyers are dropping off just a little bit, and the sellers are picking up, but did decline in Friday's session. The S&P 500 McClellan oscillator was pretty much flat. It's above zero, so that's still positive. So our summation index based on price is showing improvement, and we're pretty much flat right now based on volume. The NYSE McClellan oscillator did decline, but is still above zero. So the NYSE summation index is advancing based on price as well as volume. The Swenlin trading oscillator, we're finally seeing a little bit of a positive change here. We turned back up based on price, and we're pretty much flat based on volume. For the last 3 days, we had been declining. The Elder Impulse system for the S&P still remains neutral. The PMO is still positive but rolling over a bit. We're advancing based on price as well as volume. Our PMO study, we declined just a little bit with the percent of PMOs that are rising. We're also declining a little bit with the buy signals. We're still looking extreme with the percent of PMOs that are above zero. This can also suggest good momentum. So there's a positive side and a negative side to what we're seeing. The parabolic SAR system remains positive with the dots underneath. The slope is still continuing to advance. The MACD is rolling over a little bit, but is still positive. When we look at all of our oscillators, we're still positive in the short and intermediate term. We're turning up a little bit with the tricks, and we're pretty much flat with the KST. The Sean trend meter still continues to be extreme positive. The BPI is also extreme positive. That's the negative side. On the positive side, we're seeing more participation by a broader range of stocks, giving point and figure buy signals. The NYSE bullish percent index also continues to hang in there and is advancing. This is a little concern. We saw a real drop off with the Chaikin money flow. It's still positive, but it did decline from Thursday to Friday. Another negative sign is the Chaikin oscillator has now dropped below zero. That's negative. The money flow is declining but still above 50. The ultimate oscillator is also declining but above 50. The vortex, the green line still on top, but it is declining. The RSI, based on 14 and 9 periods, we're no longer extreme positive. We're still wondering if this further out divergence will have an impact on price. On balance volume actually went up slightly, so that's positive. And we're showing some improvement with our 200-day simple moving average study for the S&P 500 as well as our 50 period. We're lagging a little bit behind with the 50 period moving averages. And here's a histogram of that same chart. The Copic curve is rolling over a bit but continues to generate a buy signal. I don't have any Fibonacci or line studies since we're in no man's land. Our different charts, we're still showing more of a doji with the hike in Ashi, where the market's indecisive. We could take that as positive because we're not really falling. We could take that as negative because we're not really advancing. The Kigi chart is still positive but pointing down, so it's positive with a negative slant. The Renko chart is still positive and the 3-line break continues to be positive. Our indexes, we're seeing some improvement with the equal weight index. That could be longer term positive. It's still slightly underperforming the S&P. When we look at our ratio, the ratio is coming down, meaning the equal weight outperformed, but overall it's been mostly the big stocks that have led the way higher. Looking at Dow theory, we're still showing a nice little breakout with the Dow. We saw a tick down with the transports, but they're both breaking out, so these are pretty much confirming each other. We did see some strength in utilities, which put some pressure on the S&P. The transports to S&P 500 ratio did tick back up just slightly. We want to see this line continue to go up to give good solid support. And the transports in the Dow were performing about the same right now. Our equal weight discretionary and staples charts, we ticked down with the discretionary. We were up with the staples, so our ratio did fall, but we continue to be in an overall uptrend. The Dow is still above this R1 level. It was barely unchanged on the day, so it's been hanging in there. And the diamonds are still positive for the Dow. The Nasdaq, after coming up to this R2 level, we actually broke down below the R1 level, but we're not declining further, at least right now. We're still above this 61.8% retracement level. We're at about 13,874. We'll be watching that if the Nasdaq continues to fall to see if this offers support. The cumulative new highs, new lows did turn up again. They're showing some improvement. When you look down below, we are positive, but we have been seeing longer-term weakness. The Nasdaq 100 also came up to this R2 level, came back down, and closed below R1. We're wondering if this is just short-term overhead resistance, or are we going to continue to fall? We're still above the August 2022 high. The Elder Impulse system for the Qs has switched to negative. The Nasdaq 100 bullish percent index is now rolling over. Once it crosses below this line, that will be an official overbought indication, and we're wondering if that's going to become more prevalent. We're also keeping an eye on the Nasdaq 100 with the negative divergence. The PPO is also crossing over negative now. The Qs really underperformed the Dow in Friday's session, so the ratio turned down, but the Qs have been really outperforming in the longer term. We broke down with the FANG index below the all-time high. The small caps, we are finally seeing a golden cross with the S&P small cap index. So that's matching up with what we're seeing with the Russell 2000, which is this next index. We did have a recent golden cross. We have resistance above current price. The RSI is coming down after being extreme positive. The MACD is still positive, but it is rolling over. The small caps remain at neutral for the Elder's Impulse system. And small cap growth versus value did tick up a little bit, but we're going sideways for the most part. Longer term, we're still in an uptrend. The small caps tick down just a little bit compared to the S&P and are underperforming in the longer term. The mid caps are still hanging in there. This seems to be the area to kind of focus on right now to see if we're getting strength or weakness. We did decline, but we're still above this R1 level after working off of a recent golden cross. The mid-caps remain neutral for the Elder's Impulse system, and mid-cap growth ticked up just a little bit when compared to mid-cap value and is still in an overall uptrend. The dollar index has been able to get back above 100, and when we compare stocks to further out bonds, it's still suggesting that we will see a soft landing even though we tick down a little bit with this ratio. And growth did underperform value on Friday's session, but it is showing improvement in the longer term. The bank sector, after having some really strong up days, did decline in Friday's session. The financial sector is still above the 50 and 200-day moving averages, but did decline slightly. When we compare financials to the S&P, it did tick down and is still in an overall downtrend. When we look at the regional banking ETF, it underperformed the financial sector and still continues to be in an overall downtrend. Looking at bonds, where we were down slightly based on yield and up slightly based on price. We are slightly above the 50 level with the RSI, and the MACD continues to be positive when we look at this ETF based on price. We're seeing a little bit more of improvement with the longer-term relationship between the S&P 500 and the long-term bond ETF. We rolled over a little bit with the shorter-term relationship. The spread did decrease slightly, but it's still quite wide. We're also watching this chart. We're turning back up now when we compare cash to the 3 to 7 year bond ETF. We also saw a recent golden cross with this ratio. If the market was more convinced that interest rates were going to be going down, this ratio would also be going down. The fact that it's going back up is a little bit concerning. Folks are still tending to favor riskier bonds over more conservative bonds. We had fallen with this ratio, but we ticked back up in Friday's session. We're still above the level set back in 2007 with the 3-month yield. We'll be waiting to see if this drops down. Is that giving us a warning sign? Our longer-term charts were positive with the special K on the daily chart, but we're still negative on the weekly chart. Looking at our longer-term moving averages, our 150 is looking extreme positive, as is the 200. We closed just a little bit above this resistance level, so we're wondering if this is going to hold up on the S&P weekly chart. Looking at the Nasdaq 100, we also closed above the resistance line. Now, it's going to take a while for both of these charts to play out because they're much longer term and they're based on a weekly basis instead of a daily basis. We ticked down just a little bit with our Nasdaq 100 ratio to the Dow, but we're still at a very high level. We're wondering if we're going to be able to go back higher, or are we going to start to drop from here? An update of our possible positive scenarios. We turned down with the Qs to S&P, discretionary to S&P, and large cap growth underperformed large cap value. With the growth to value ratios down with the large caps, mid caps, and small caps. The S&P to utilities ratio did decline a little bit, but we continue to rise overall. When we look at the broad market of the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows, we are still positive with this, so that is holding up, showing more strength in the broader market. We're also still at this extreme positive reading with the 10-day average of the S&P highs minus the lows. The longer we can camp out here, the more it suggests there's good momentum. The 50-period exponential moving average of the new highs minus the new lows continue to advance. The black line, which is our indicator, is positive, and the red line, which is the moving average we use, is continuing to go up. We turned up slightly when we compare growth to value for the S&P. We're declining overall, but we still remain in an uptrend. The staples to S&P 500 ratio did spike up a little bit, but overall we have been declining. That can give good support to the S&P. So what's our outlook for Monday? This coming week on Wednesday, there'll be policy meetings for the Fed. That's the most influential to us. The European Central Bank and the Bank of Japan. They'll all be meeting on the same day. The rebalanced NASDAQ 100 will start on Monday. That could be either positive or negative. Not sure how that's going to play out. The technicals are still positive, and as of right now, it looks like we're just working off being overbought. We will get the S&P Global U.S. Manufacturing as well as the Services PMIs, the preliminary reading on Monday, and then we're keeping an eye on all the geopolitical events. The stock market still remains fixated on inflation and interest rates. Here's the upcoming economic calendar for the week, with the big one being on Wednesday when the Fed will make their announcement. We're also going to get the advanced GDP reading on Thursday, and then the big inflation report will be PCE prices that comes out on Friday. Looking at the Stock Traders Almanac statistics, we are now going to be in the week after options expiration, where we're 50-50 across the board. So it's a roll of the dice as to how things will play out. For July 24th, the Dow is quite negative, where we're neutral to positive with the S&P, and the NASDAQ is neutral to negative. We will be on the 15th trading day of the month, where in some instances we see some weakness, in other instances we see some strength. We're also past the midpoint in July now, so the NASDAQ, at least historically, will show some weakness going into the latter part of July. So our scenarios, not going with the down one yet. We're still positive with the technicals, and right now it looks like we're working off being overbought. We can't really go with the up one yet because we're not really seeing a lot of strength, even though there is some improvement in the charts. If we were to default to anything, it would be to the upside. And we're not going with the sideways trend because our ADX is suggesting that we're in a strong trending environment. The warning signs, we're still keeping an eye on this convergence of these short-term bearish signals. The S&P to VIX ratio, that could still have an impact. The 5-day simple moving average of the equity put call ratio, we don't know if that's bottomed yet. The negative divergences that we're seeing, mostly for the NASDAQ 100, and we are at that point now where we see weaker seasonality for the month of July. The longer-term trend signals based on the weekly charts, we don't know if that's signaling a top or not. That's going to take a while to play out. We are in a seasonally and historically weak time of the month. The oscillators still continue to show that negative divergence, but they are improving. We're still really focusing on the NASDAQ 100, and that PPO has switched over negative. The VIX is showing a lot of complacency and acting weird. That's why we're watching the S&P to VIX ratio. The cumulative new highs, new lows for the NASDAQ, even though they ticked up the last few days, overall they continue to show weakness. The 3-month yield is above where it was at back in 2007, right before the great financial crisis. We're wondering if that's going to give us some kind of a warning. The S&P growth is showing weakness, even though it ticked up in Friday's session and is still in an overall uptrend. And then earnings season is upon us now, and that'll be based on what is reported. The positive signs. In the longer term, we still have positive seasonality and setups that I'll go over more in the weekly video. The long-term daily special K chart continues to be positive, where the weekly chart is negative. The equity put call ratio continues to decline when we look at that longer version of it. The S&P remains above the downtrend channel upper line. We're still in a risk-on posture. Lower price levels may provide support, and so far that seems to be playing out, but that could change at any time. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're continuing to break out. They're above those resistance levels, but they also came back from those pivot levels. The Staples to S&P 500 ratio is declining. The small cap indexes that we look at, both the Russell and now the S&P small cap index, as well as the mid caps, have generated recent golden crosses. That's more of a confirmation. Small and mid cap growth continues to be positive, especially mid cap growth. And the Copic curve, even though it's rolling over a bit, generated a recent buy signal. Our conclusion, the S&P remains positive, and it continues to work off this overbought situation. As of right now, that's what it looks like. We'll have to see if more weakness develops next week. In the short term, we're positive and working off being overbought, as well as the intermediate term, we're still positive in the longer term. Thank you. Have a really nice weekend, and I will talk to you in the next video.